China is leading losses in Asia-Pacific on Thursday, followed by Japan stocks, which resumed trading after an extended New Year's holiday in which the country witnessed an earthquake, but also an accident involving Japan Airlines. We have the Shanghai Composite today down 0.37%, Kospi in South Korea down 0.78%, and the Nikkei in Japan down 0.6%. Performance is subdued as markets are taking cues after minutes of the US Federal Reserve meeting in December showed interest rate cuts are likely in 2024, but still provided very little clarity on when that might happen. So let's try and shed some light on this with Neil Wilson in London. He is the Chief Market Analyst at Finalto. Thank you for joining us. Right, so when do you think then, at this point, it is more likely for the Fed to start cutting this year, and why?
So at the moment, we've had the Fed meeting in December. We've had the minutes from last night, and it's been a bit of a mixed picture. We had quite a dovish message from Jay Powell in December, the Fed chair. He started talking about rate cuts, and that got the market thinking that we're going to be heading into a quite aggressive cycle of rate cuts beginning quite early this year. So the market is still pricing something like a two-thirds chance, roughly, that the Fed starts cutting at its March meeting. And then carries out several more cuts this year. I think based on where the inflation outlook is at the moment and just how resolute the Fed has actually been, and particularly in some of the details from the minutes last night, I think much more likely is that they delay and that March is just a bit too soon. And I think we're looking at probably June at the earliest for a rate cut. That's partly because inflation is going to be pretty sticky. It's because the Fed doesn't want to risk pulling out too soon, and it's mindful of allowing inflation off the leash. And if it is successful in a soft landing, then the greater risk is that inflation starts to pick up again. And so I think it's going to be mindful of that, and I think that's why it's going to be higher for longer than the market currently thinks. And that obviously could weigh on risk assets as the market and investors will start to think that the Fed is being too restrictive with its monetary policy.
Right. And Neil, we've seen Asian stocks all in the red every single trading day of the first week of the year, right? Are there other reasons why we've seen these Asian stocks falling apart from, the Fed?
Yeah, well, I think, the China growth story remains sort of sketchy. Some of the PMI data has not been too overwhelmingly good. You've got deflation still in China. There are geopolitical risks as well. But I think, and overnight, there was a downgrade by Fitch of 4 Chinese asset managers citing property market risks. And sort of just general economic risks in China. So there are still concerns there, and I think that the market at the moment is in a bit of a wait and see mode. It's had a really good run up post that Fed meeting and post really the end of October. So the market in the US and Europe's had a good run up, but it's been a bit less impressive in Asia last year, and I think we're still looking to see what what the growth story looks like this year, and there's a lot of uncertainty right now. So a few sort of things swirling around there that's just putting a bit of pressure on the Asian market.
Surely, and subdued sentiment in China having an impact as well. Neil Wilson, thank you very much. And now let's go to other top stories from around the world. Argentina's President Javier Milei has suffered his first judicial setback just months after coming to power. The country's labor appeals court suspended a key portion of his sweeping economic reforms aimed at overhauling the South America's second largest economy. In December, Milei unveiled several changes to labor rules, such as reducing severance compensation and cutting pregnancy. US bankruptcy filings have surged 18% in 2023, faced with higher interest rates and stricter lending standards. Total bankruptcy filings involving commercial and personal insolvencies rose to almost 450,000 last year, up from over 378,000 from the year before. Experts say cases of bankruptcy are expected to keep climbing in 2024. And Telefonica has reached a deal with unions to cut up to 3,500 employees in Spain, nearly 1/5 of its domestic workforce. The Spanish telecoms giant said the departure are expected to take place during the first quarter of 2024 and would cost around $1.4 billion. The layoffs are part of the company's 3-year strategic plan to reduce costs.